Good morning, and welcome to this KBRA webinar titled Navigating the Private Equity Landscape, NAV Loans Still Perform. While all attendees have joined in listen-only mode, we encourage you to engage with our speakers through the Q&A feature on your control panel. Additional research, as well as our rating reports, can be found on our website at kbra.com. We also have a dedicated page which contains all of our private credit information in one location. That link will be shared with you during and after the webinar. Should you have any additional questions on the topics discussed today, we are always available for a follow-up call. Now, I'd like to hand things over to our esteemed speakers for introductions.
Thank you, Michelle, and good morning, everyone, and welcome to KBRA's webinar on NAV facilities and their evolving role in the private equity and secondary funds market. My name is Eric Neglia, and I'm the global head of KBRA's funds rating business. Today, I'm joined by Tom Spiller, managing director and global head of fund finance, including subscription lines and NAV loans. I'm also pleased to have Min Shu, managing director in KBRA's funds rating group, who's responsible for our fund research. KBRA's fund team includes over 50 dedicated analysts located in New York, London, and Dublin, all committed to delivering analytical excellence, rating transparency, and value for our clients and investors. Across the private capital markets, KBRA maintains over 900 ratings on more than 800 transactions for over 100 unique sponsors. Today, Tom, Min, and I will explore recent developments in the NAV loan market. We'll discuss the factors driving the demand for NAV facilities, the types of NAV loans available, and the key analytical considerations in assessing these loans. We'll also look at current trends in NAV loan performance amid shifting economic conditions. As Michelle mentioned, you can submit questions as we go along, and we'll do our best to address them. With that, let's start by diving into the rapid growth we're seeing into the NAV loan market and the factors that are driving this trend. As outlined in KBRA's recent report published on kbra.com titled Navigating the PE Landscape, NAV Loans Are Still Performing, the NAV loan market has seen significant expansion, with issuance volume growing from $27.5 billion in December 2022 to $51 billion by mid-2024. The report also highlights an increase in NAV loan users, including 40 unique asset managers. Min, can you share your insights on what's driving the strong demand for NAV loans to private equity and secondary funds, especially the rising demand for rated NAV facilities?
Absolutely, Eric. So NAV loans have actually been around since the early 2000s, but we saw significant growth in the last 5 years. If Michelle, you could go to the next slide. This shows that volume has really picked up since 2021 and has remained largely stable in the last few years. Firstly, this is because GPs are more open to using NAV loans as an alternative liquidity source, in addition to the more traditional fund finance products such as sublines. For recent vintage funds, more LPAs are now also including explicit language that NAV loans are permitted indebtedness, and some LPAs also specify whether LP consent is required to take on NAV loans. This increases the transparency and potential utilization of NAV loans. Secondly, the higher for longer interest rate environment in the last few years has resulted in a material slowdown in M&A and IPO activities, which has led to longer holding periods for PE investments, and as a result, slower distributions to LPs. NAV loans give PE fund managers an additional source of liquidity. So instead of calling capital from LPs, they can use a NAV loan to finance bolt-on acquisitions for existing investments, which could be value accretive over the long term, or to refinance portfolio level debt, which could be more costly. Some NAV loans are also used to make distributions to LPs. For secondary fund managers, on the other hand, NAV loans are primarily used to finance portfolio acquisitions, which has been fueled by the growth in the secondaries market in the last few years, also in part due to the liquidity concern that I mentioned previously. For rated NAV loans, that demand has grown, coming from asset managers who are increasingly investing on behalf of insurance capital, bank lenders, in particular some European banks who are looking for ratings for internal validation, and also non-bank lenders in some of the lending syndicate that we have seen.
That's great. Thanks, Min. So Tom, how has the recent growth in the NAV loan market been impacted by banks' balance sheet constraints and the increasing participation of non-bank lenders and insurance companies?
Yeah, so we provide ratings on NAV loans for a number of reasons. Certainly, as Min just highlighted there, the motivations for rating a transaction can include things like internal risk validation on behalf of a bank, or investment considerations for certain entities, including non-traditional lenders. But a large proportion of our ratings activity certainly is driven by, I guess, the growth of the non-bank lender space, with the introduction or the inclusion of, say, insurance companies coming into the NAV lending market. So we work with both banks, provide ratings on behalf of bank facilities who are looking to syndicate to non-bank lenders. That could be used for help for managing single name exposure limits or other distribution efforts on behalf of the bank. And we also rate a number of facilities on behalf of alternative investors who are also managing capital on behalf of insurance entities. So a large, I guess, driver of the growth of ratings we have seen, particularly obviously as observed in the chart, has been driven by the entrance of non-bank lenders. I guess one of the other reasons which we rate facilities in the fund finance space can also be for regulatory capital relief. So more, I guess, a bank-driven rating in that sense, or potentially looking for regulatory capital improvement. We see that more in the subline space, admittedly, to date, but certainly it could be a driver of ratings going forward in NAV. The other thing I just point out, I guess, obviously we have seen a significant driver or increase in ratings within the NAV space, but to date, the universe of NAV loans that's rated is still, I guess, a small proportion of the overall NAV financing market. So I think there was a recent white paper recently provided by Ares that estimated the total size of the NAV financing market north of 200 billion. Across both secondaries and buyouts, whereas our ratings for NAV financing is around 50 billion or so. So we're still rating a significant proportion, but it's obviously a relatively quarter of the size of the total market. But over time as well, that could shift depending on how banks are looking to syndicate, or the introduction of more non-bank lenders into the space.
That's great. Thanks for that perspective. Looking at the questions from the audience, we do have one question related to volume. I think both of you touched upon this a bit, but the question is around cyclical factors that drive volume in different segments of the NAV loan markets. Tom or Min, do you want to take that question, maybe expand on it a little bit?
Sure, Eric. So interest rate is going to be clearly a key driver on both the direction of the base rates and the spread level for NAV loans in relation to competing products. That's going to affect how frequently NAV loans are used. Also, interest rate has direct impact on the capital markets activities. So if M&A and IPO activities pick up, realization of existing investments, PE investments, will accelerate, which could increase the distributions and also recallable capital. So that could have a bit of a reduction in demand for NAV, cause a bit of a reduction in demand for NAV loans to PE funds. For NAV loans to secondary funds, demand should continue even if M&A and IPO volumes increase, because it seems that GPs and LPs are increasingly focused on actively managing their portfolio and have seen NAV loans as an effective tool for that. But regardless, I will say that, given the continued growth of private markets and the greater acceptance among GPs and lenders of NAV loans as another, tool for liquidity, we think that healthy growth should remain for this asset class, even in a less liquidity constrained environment.
Great. Thanks, Min, for that additional detail. So KBRA's report that we published recently at the end of last month indicates that most NAV loans are utilized for purposes such as follow-on investments, extending hold periods to prevent forced sales, or refinancing existing debt, with only a small portion directed toward distributions to LPs. Tom, how frequently do you see restrictions being applied to the proceeds designated for LP distributions? Yeah, it's obviously a very topical point. There's been a lot of focus in certain news articles about the use of NAV for distributions. I think certainly, as you mentioned, the majority of the NAV loans that we've assessed or rated have been for purposes other than distributions. So typically supporting the underlying portfolio company, whether that's
additional add-ons or refinancing potentially debt at portfolio company level, or other fund level debt that needs to be refinanced, potentially other working capital needs of the fund. We have certainly seen some NAV loans used for distributions, but generally that has been a relatively modest part of our portfolio. So we estimated that below 20% of our total portfolio has been used for distributions. I think that's also in line with other studies that have been taken part by other market participants. I think Citco, for example, recently estimated that less than 15% of the total NAV universe has been used to fund distributions. So there is obviously some usage, but it's generally a small proportion of the total NAV market. Ultimately, as mentioned, I guess a lot of our NAV loans are used for other purposes, and certainly as part of our ratings process, the use of proceeds is very carefully considered as we assess a rating for a NAV loan. And we would expect to see that to the extent there is a defined usage of the facility, we would expect to see that reflected in the facility agreement itself. So potentially including cap on or restrictions on the use of financing for distributions. And so generally speaking, that has been the case across the majority of our facilities.
That's interesting. So with 20% being used for distribution, is there anything, any market sentiment or any conditions that can change these distributions in the future?
Yeah, I mean, it's obviously a very topical point just now. There's been a lot of focus on this, a lot of negativity, shall we say, around the use of NAV for distributions. There's obviously some good reasons for that from certain LPs, and certainly obviously the industry has been very focused on ensuring appropriate disclosure on the use of NAV loans, which is obviously, I think, broadly speaking, will be supportive or helpful for the market at large. Personally, I think that over time, the NAV financing world will be viewed as another tool in the toolkit of the GP. So certainly, there's obviously a raft of different liquidity and financing options that are available to GPs, and NAV is just another one of the liquidity options that can be used. And the assessment to whether or not to take out a NAV loan at the fund level, supported by the portfolio company, should be weighed against those other options that the GP has at their discretion. And so potentially there could be some, I guess, legitimate or sound logic for having a NAV loan used for distributions, if it is obviously meeting the certain needs of the fund and the investors.
Great, thanks, Tom. We have a question from the audience here regarding the rationale behind getting a rating. Do you see GPs getting facilities rated ahead of closing for pricing improvement? So maybe you can just touch upon the rationale for the ratings.
Yeah, it's a very good question. I think for the large majority of our universe of ratings, we're usually rating after close, or in some cases we're engaged as the facility is closing, so you have a rating as close to close as possible. So not necessarily immediately driving a pricing improvement, but certainly there is obviously a large proportion of the rated universe where there is expected to be some distribution of a loan, and so that could have potential. I don't know if that potentially could have some pricing implications, thinking about the liquidity that's available, but for a large part, a lot of our universe is rated after the close of the facility, and so not necessarily then driving a pricing impact.
Great, thanks, Tom. So again, as we described in the report, NAV loans can be broadly categorized as either secondary fund NAV loans or direct private equity fund investments. Min, do you mind describing these two types of NAV loans and then just compare the key similarities and differences between them both?
Sure. So both types of transactions, they have largely modest initial LTVs, and then also LTV triggers and cash sweep requirements that are tightened if there's credit deterioration or portfolio concentration beyond certain thresholds. An important consideration is also that there's typically scheduled amortizations that tend to step up as the transaction approaches maturity, which is important in terms of mitigating repayment risk. I think the key differences between those two products, if Michelle, you could go to the next slide. So the main difference is really the portfolio concentration. So if you look at the bottom portion of the slide, that shows you the initial LP interest for secondaries and initial asset count for PE. So the secondaries NAV chart, just one note, the vertical axis shows you the log value of the LP interest. So For example, 55 LP interests would translate into a log value of 4, 148 LP interests would translate into a value of 5. So as you can see from the chart, most of the log values are falling, 3 or above. So that implies that the median LP interest count for our portfolio is 54. So that ultimately translates into, hundreds or thousands of underlying companies that are backing these LP interests. So highly diversified. There's also usually reasonable diversification by GP, by strategy, and by vintage, which is also important since you want to see cash flows coming in at different stage of the NAV loan's life. So because of this inherent portfolio diversification, there's a lot of predictability with the cash flows for NAV loans to secondary funds, and even in an economically challenged environment. On the other hand, PE NAV loans are backed by much more concentrated collateral, as you can see in the bottom right chart. So even though there is there are some outliers in terms of the number of assets, especially for ratings of A- or below, you tend to see 10 to 20 portfolio assets backing the NAV loan. So that's quite concentrated. As a result, the biggest mitigant to the portfolio concentration is the initial loan to value. So top part of the chart, top right is the PE NAV chart. You can see that the initial LTV falls between 10 to 20% for most of the transactions. The median value is 12.5% for our portfolio. And this compares, to the secondaries NAV loans where the LTV can go to almost as high as 60%. So, and the median value, by the way, is also 35% for our rated portfolio. So the main driver here is really the concentration. The report also goes into detail a bit on other types of differences, such as security package and valuation, which I won't go into detail here, but they are laid out in the report as well.
Thanks, Min. We have another question here. I think, again, we mostly answered this, but if you maybe just want to kind of pull out some of the key points. You mentioned secondary funds have broader diversification compared to the PE funds. How does this impact the risk profile and terms lenders require for each? I think you mentioned, again, the more predictable cash flows and higher LTVs for similar categories, but anything else to add related to that question?
Yeah, so, I think not surprisingly, because of the higher portfolio concentration, we do tend to see higher liability spreads on the PE fund NAV loans. The typical range has been 4 to 7% with, a bigger variation versus secondaries tends to be between 2.5 to 3.5%. We do caution that these are highly bespoke structures and can be influenced by a number of factors other than credit-related concerns, since some of these could be negotiated on a bilateral basis. The other factor is the maturity of the NAV loans. So the median maturity for a rated portfolio is actually 5 years for both types of transactions. However, for PE fund NAV loans, there's a larger variation. So we've seen maturities up to 12 years. And that's really because, GPs want to seek maximum flexibility to have the option to hold on to their assets longer and avoid a forced sale.
Min, did we lose your audio there?
Sorry, can you hear me?
We can hear you now.
Okay, great. That's all I have on this point.
I think we lost a little bit at the end, but I think we got the gist there. So thank you for that. Moving over to the next topic. So Tom, you're responsible for overseeing the fund's finance transactions. And as I mentioned in the opening, that includes the subscription lines and NAV facilities. To date, KBRA has rated over 300 of these transactions since inception. So do you mind explaining KBRA's analytical considerations when assessing these two types of NAV loans?
Yeah, I'm happy to. So I guess firstly, in terms of the methodology that we use to assess all of the debt transactions within our funds team here at KBRA, we leverage our investment fund debt methodology, which considers both quantitative and qualitative factors. As mentioned, I guess it does address all of the transactions that we have within the funds team here at KBRA, which includes sublines, includes NAV to other types of funds, such as alternative credit or credit facilities to credit funds, We also have hybrid facilities in some form. We also rate CFOs and other transactions that fall within our fund investment portfolio, such as rated notes. The methodology, in case anybody is unaware, is available on our website, along with the publication, of course, that we're going through. To access the publication and other research material that we have, you just require a KBRA login to access those. But the methodology is broken down into 5 quantitative determinants and 3 qualitative factors. We differentiate between transactions by assigning different weights to the quantitative determinants that's most relevant for the transaction. So in the case of NAV loans, the heaviest weight that we assign from a quantitative perspective is to asset quality, asset coverage, and cash flow analysis. And then we also have a smaller weight assigned to a liquidity and a duration component from a quantitative perspective. Those 5 quantitative factors, the weights and scores assigned to each, will ultimately drive a rating, an implied rating outcome. And from there, we adjust based on 3 qualitative factors, being a manager review, a legal review, and then other qualitative factors. Maybe just touching quickly on the key quantitative aspects of our NAV loan universe. So from an asset quality perspective, asset quality ultimately is assessed based on the pledged collateral that supports the transaction. So in this case, being either portfolio companies or LP interests in funds, and likewise, given the equity nature of those pledged collateral, our asset quality score would be consistent with equity or equity-like risk. From an asset coverage perspective, we consider the total size of the loan relative to the pledged collateral value. But this calculation, we further adjust to consider the long-term asset coverage in the context of the expected monetization profile and contractual cash sweeps that will repay the loan. So this is effectively trying to capture the impacts of cash sweeps and LTV-based triggers that could drive a higher or lower LTV as the transaction nears maturity. So, for example, in the case of a secondaries NAV loan, quite often we see a cash sweep holiday that exists at the start of a transaction's life, where naturally the LTV will expect to trend up over time until or unless you hit an LTV trigger. And then as the secondaries NAV loan gets closer to maturity, there's typically an increase in the cash sweep, so your LTV will trend down. And so we look at a weighted average LTV that basically looks at the LTV throughout the life of that profile to really kind of assess how the NAV loan is expected to perform based on a projected distribution schedule. The idea here being that we don't want to have significant ratings volatility as a result of the loan basically performing in line with expectations. So that's from an asset coverage perspective. And then from a cash flow perspective, this is really considering the strength of the transaction structure and the level of underperformance the NAV lenders can withstand while still receiving full repayment of the interest and principal due in the facility. So this considers the absolute fund level performance, the risk of concentrated or single asset exposure, as well as other market-based stresses to portfolio value and liquidation timing. Worth noting here that the structure of the facility is clearly very important. So we're assessing the strength of the cash flow structure, such as how this ensures the repayment of the rated debt if the portfolio LTV were to increase or become more concentrated. So this cash flow analysis, I guess, worth noting, it does differ quite significantly between secondaries and the concentrated or the PE NAV loans. Although in both instances, we're typically starting with the borrower's expectations of transaction performance, such as the projected distributions. In the case of secondaries, we then take those projected distributions, run those through the cash flow waterfall, and calculate a break-even level of performance that the transaction can sustain while still being able to repay the rated debt. We then supplement that analysis by stressing the timing of cash flows, so thinking about potentially bringing forward a significant proportion of the cash flows or delaying distributions, depending on what could be potentially more stressful to the structure. We also would leverage potentially some historical performance of vintages for buyout growth credits, depending on what's ultimately the underlying LP interests, to help supplement some of the timing analysis that we can do for when we're running through the cash flow. And then ultimately, as mentioned, effectively trying to calculate a break-even level of performance under those various timing assumptions. On the concentrated or the PE NAV side, I shouldn't probably use the word concentrated because as shown on the chart, there can be quite a difference in concentration for private equity NAV loans, but we refer to them internally as concentrated to differentiate it ultimately from the secondaries world. But in the PE NAV world, we're ultimately have much more focus on the individual companies within the portfolio. So here we're delving into the portfolio companies, understanding the recent performance of the company, such as trends in the revenue, the EBITDA, and how that's translated into the valuation that's being held on the fund's NAV. We'll also look at the leverage that exists at the company level, so to effectively, capture the debt across the full capital stack of the fund, and think about any near-term debt maturities as well to see if there are potential near-term stress or other factors that we should consider as part of our cash flow analysis. So again, typically starting with, say, the GP's projected timing and exit valuations for their portfolio companies, and then we layer on additional stress by adjusting the timing of distributions. Potentially, based on some of the analysis of the underlying companies, we may push some exits beyond the life of the loan, such that there's no benefit to the lenders from the distributions from certain assets. But we in those scenarios, we would keep the value constant. So you're effectively lowering your LTV, which in turn might reduce the amount of cash that you sweep to repay the debt. And then again, calculating a break-even haircut on the equity value that can be sustained. But we also think about the break-even haircut that implies to the enterprise value on the underlying portfolio companies. So again, considering the leverage that exists ahead of the NAV loan at the portfolio company level. On the buyout side, we then supplement that cash flow analysis with other types of scenario-based analysis, such as considering, based on the strength of a transaction, how many portfolio companies you require to sell in order to repay the rated debt. So thinking about concentration risk that could exist towards the end of the life of the loan. So those are the key quantitative drivers. And then from a qualitative perspective, clearly one of the key things is going to be the asset manager themselves. So there we're assessing, does the manager have demonstrated track record of performance through market cycles across previous vintages? We're thinking about, obviously, the valuation methodology of the manager. Typically, in the case of PE NAV loans, the valuations are derived by the NAV reported by the manager. So we will diligence and understand how appropriate those marks have been historically. So has there been a consistent ability to value assets at a level that is equal to or below the ultimate monetization of the associated investments? And typically, from what we've seen across our NAV loan universe to PE funds, is that there's usually a bump on exit when managers are selling assets, which I think does support a lot of what we're told in terms of the fact that the marks of private equity are typically relatively conservative to try and again avoid too much volatility throughout the life of the fund. We'll also consider other aspects of the asset manager's policies and controls, addressing things like portfolio management, risk compliance, as we consider the asset manager and the strengths of that from a qualitative perspective.
That's great. Thanks, Tom. A lot of information there. While you were discussing, there was a couple questions coming in, so I just wanted to pull out some of the key topics that the audience had questions on. The first one relates to getting our perspective on diversification and valuations. Do you mind going into a little more detail on how we measure diversification and review valuations?
Yeah, so I guess in terms of diversification, clearly, obviously, in the private equity space, looking at the number of companies, but we're also looking at it through the life of the loan. So thinking about the strength of cash sweeps. And maybe to that end, I guess if we can flip, Michelle, sorry, to slide 6. I guess I'll just show you just the next one, please. And on the PE side, we're thinking about the diversification benefit really here is driving outcomes as well over the life of the loan. So if you look at the top right, thinking about, again, the minimum required asset count by initial ratings, this is effectively at the point at which you typically would trigger 100% cash sweep. And so stronger facilities may benefit from having higher requirements to sweep more cash in the event that portfolio does become more concentrated. So thinking about it through the life of the transaction. Whereas on the secondary side, we do measure diversification by things such as by the underlying GPs within a fund, by LP interest, by strategy. And we quite often measure diversification using the 1 over the Herfindahl index. It's also something we leverage as part of our subline analysis when it refers to LPs in that sense. But this is effectively a measure of diversification that adjusts for the percentages of, for example, the LP interest within a portfolio And typically speaking, a more diversified portfolio could drive or have a higher LTV and still arrive at similar rating outcomes.
Great, thanks, Tom. All right, moving along, maybe let's just focus on future performance. Min, Tom, love to get your perspective on what we expect in the future. As we look ahead to 2025, what are our expectations for NAV loan performance? Are there specific economic or market factors that you believe will have the most impact on NAV loan performance over the next year or so?
I could start. So as Tom mentioned before, we don't rate the entire NAV loan market, so we can probably only speak to the portion that we do rate. But we do believe that, the last few years with the economic headwinds, our loan portfolio has shown resilience, with many loans were fully repaid or successfully deleveraged ahead of time. So the initial LTV and other structural protections are really key to have driven this performance. We think that this trend will continue, and even recently when we saw some larger PE investment write-downs in occasional transactions, that has not had a material impact on the NAV loans performance, which we see as a positive sign. And I think looking ahead, lower interest rates, should that materialize, should help with the exit environment for PE funds. So that would allow for more realizations and potentially faster amortizations of the NAV loans, which would be a positive. I think the only kind of negative scenario I would mention is really we're continue to be pretty vigilant of watching out for NAV loans that ultimately have exposure to more concentrated portfolios. So we have taken 2 negative rating actions so far on NAV loans, and both were pertaining to funds with significant energy concentration. So that's something that we're going to continue to be watching out for. And just to note too, those 2 transactions were ultimately still fully repaid before their legal maturity.
Yeah, maybe to add, I guess, on the secondary side, I think it's fair, and obviously given the well-documented slowdown in exits, we have seen a slowdown in distributions from the underlying LP interests that are supporting the repayment of the debt. A lot of, as been described, we haven't had any real negative rating actions yet on the secondary side, and that's largely driven by a number of factors, including managers' use of leverage, which quite often they're paying down ahead of schedule. In some instances, that's again supporting the debt at a certain level that might offset lower distributions from the portfolio. There's obviously a lot of diversification within the portfolio, so although there has been some underperformance in some aspects, the NAV of the portfolio has relatively been stable, and again supporting a kind of a relatively modest or healthy LTV on these facilities. And I guess maybe conversely, as you potentially rather unusually from kind of a risk perspective as well, a lot of the distributions that were projected to come back could have been during a cash sweep holiday. So we've seen for some of the facilities that we've rated, there's been a dry up on distributions, but those distributions would ultimately have been or could have been used to repay to the borrower as a result of the structure. So in some instances, a delay in distributions could actually be beneficial to the ultimate performance of the NAV loan. That's obviously not universal, but we have seen that as well. And that's helped support relative stability in ratings on this. On the buyout side, we have certainly seen some isolated or idiosyncratic issues within portfolios. And indeed, obviously, there's been some instances of defaults within our universe of PE NAV loans at the portfolio company level. Just to be clear, no defaults at the NAV loan level. But in some instances, there have been some issues within portfolio companies. But again, based on our universe of ratings, largely speaking, the portfolio effect has helped to mitigate against those issues. So whilst there has been underperformance in certain companies, other companies have outperformed. And again, LTVs have remained relatively stable, if not better than they were last year. So we would expect, I guess, as a whole, KBRA have been very active across the private credit landscape. So we've been particularly active across the private credit area as part of obviously the ratings that we do within the funds team, but also within our structured credit team and corporates team. And that we think has given us a relatively unique window into the world of private credits as part of the credit assessments that we're performing on the underlying portfolio companies. As a firm, we've released a number of research topics on this area that's assessing the potential performance of private credit, obviously at the loan level. And we are expecting there to be some increases in default, but broadly speaking, it's not going to be materially increased compared to where it is today. And likewise, we're expecting that to also translate into how that performs on the buyout NAV loan side, given a lot of these funds are ultimately the debt is provided by other private credit lenders that we're seeing as well.
Great, thanks, Tom and Min. So it sounds like, you know, diversification is one critical factor. You mentioned that there were certain portfolio companies that may have defaulted, or you have lower valuations, but that may be offset by overperformance in other portfolio companies. Are there certain sectors or types of funds that might perform better or worse under the current economic conditions that you mentioned?
Yeah, that's a very good question. I think certainly if probably refer back as well to the private credit research that we have that we're producing, again, looking into the underlying portfolios, the loans that we're seeing are assessing as part of the various transactions that we rate within KBRA. And certainly we are starting to see a buildup of stress in certain pockets of some parts of the market, such as healthcare. But broadly speaking, again, the loans that we're rating are very relatively diversified across industry. So we did have some isolated issues within some sectors, but our universe of NAV loans tends to be relatively diversified. And likewise, not necessarily some of those issues might drive issues in terms of our ratings.
Great. Thanks, Tom. So we have a couple other questions, but I think most of the questions were addressed in the remarks already. So I think with that, we're just about out of time. So I would like to thank everyone for joining today. Special thanks to Tom and Min for sharing their insights on the NAV loan market. If anyone in the audience has any further questions or would like any additional information, please reach out to us. We'll look to get back to you. But I would like to, once again, thanks everyone for your time today, and have a great day.